Please welcome Managing Director of AB Bernstein, Richard Clarke.
Well, good afternoon. I'm Richard Clarke. As it said in the introduction, I'm the Managing Director at a financial firm called AB Bernstein. So before you all leave, hopefully I can persuade you that there's some interesting content in here. So I'm the imposter. I don't run a hotel. I don't own a hotel. I don't manage a hotel. I don't work in an OTA. But I spend my entire life looking at the leisure industry, in particular the blue chip stocks that was in there. So within the next 10 minutes, I'm just going to show my musing. I got a nice little introduction from Catherine Dalton of IHG that I'm going to show the investor view. I'm going to show the investor questions and then my view on those. If I can. Oh, here we go. Okay, so what questions do I get from investors? When I talk about investors here, I mean equity investors, so hedge fund, long-only funds, etc. What questions do I get at the moment? What are investors worried about? Is the recovery complete? Is there any more tailwinds to come post-COVID? Or is it now just all about the overlaying macro situation? What about rates? Is there some bubble around hotel, vacation, rental rates that we should worry about? The other rates, as in interest rates, how are those going to impact hotel construction? Obviously, for some of the asset-light companies, they rely on third-party finance to build their hotels. Are there any COVID-led structural changes in customer behavior that will affect the winners or losers? Airbnb is the most expensive, the highest multiple of the blue chip stocks. That's fine if it's going to grow fast. Does it still have room to grow? And what about AI? Obviously, we were all told, every speaker here was told we had to talk about AI. So I'll have my own perspective. So far this year, if you look at the light blue lines here, we've had a good start to the year. Every stock is up year to date. And in fact, every stock has, apart from TUI, they were on stage earlier, obviously they've done a capital raise, which has affected their numbers, but every stock, apart from that, has outperformed the S&P 500. So despite some of the macro concerns and some of the financial concerns, and normally you'd expect hotel and OTA stocks to be more cyclical, they've actually outperformed this year, probably helped by the fact that they've underperformed at the back end of last year, but also some of the hope around the China reopening. So we're off to a good start. We're in Europe, so I think we can see clearly here that US stocks have outperformed European stocks. So there's still some catch up if we look at from pre-COVID to now. The likes of Accor and Whitbread are still some way off where they were pre-COVID, whereas a lot of the US stocks like Hilton, Marriott, Hyatt, Booking, etc. have recovered fully. As I say, that first investment. Oh, by the way, I know that some of these are a little bit small. If there's anything here you can't read, please reach out, richard.clarke@bernstein.com. Happy to share a PDF of the slides with you afterwards, Clarke with an E. So my view is that we're still moving in the right direction. If you look at the two bottom charts here, really these lines which show occupancy, rate, and ADR in the US and Europe are still largely moving in the right direction. And I think importantly, occupancy has still not recovered. Even in those regions, in Asia, there's even more recovery to come. Even in those regions, occupancy has not yet crossed 2019 performance. When I do my macro modeling of what demand should look like, which is the top chart, I find actually an even bigger gap. We should have more hotel demand now than we had in 2019, and we're still a little bit below. That's total demand. So there's still actually about 7% catch up to come to back where the macro situation would have us. That's a bigger drop in demand, a bigger increase in demand than the drop in demand we saw in 2001. It's not far off the drop in demand we saw in 2009. So recovery is still, for me, coming out of COVID, still the major force on the lodging industry. If we look at the big companies that I cover, there are quite big differences with how they perform. Most of the hotel names have not seen yet, on a full year basis anyway, on 2022, not yet seen a full revenue recovery. Hyatt's the exception. Hyatt bought ALG, so there's some M&A included in that. But almost all of the hotel groups have seen a full EBITDA recovery compared to 2019 already. On the OTA side, probably actually a closer revenue recovery on average, Airbnb 75% above, But more of a mixed message, I think, around EBITDA. You've seen some different priorities from the OTAs. Expedia's recovered its EBITDA, hasn't recovered its revenue. Booking's recovered its revenue, but not its EBITDA. We'll come on a little bit more to that in a second. Now, what about rates? This is the second factor we had. I definitely get a lot of questions. Surely rates are incredibly expensive. I guess when I'm speaking to hedge fund managers, they're probably mainly talking about luxury properties. Normal hotels are not that expensive relative to inflation, particularly in the US. It's a bit more in Europe. I think the illusion is that from 2020, hotel prices have caught up a lot, but of course they dropped during the pandemic. So there's sort of 2 year-on-year increases a lot. But actually, relative to inflation, we look all the way through the pandemic, hotels are actually not that expensive in real terms. The exception, certainly in the US, is luxury. Luxury has got a lot more expensive relative to other chain scales. But we think that's just a continuation of the trend that we saw. Luxury got more expensive relative to the chain scales all the way through the period from 88 to 2008. It's paused in the global financial crisis, and it's just got back to that line. So we think that that's just rational for luxury pricing. A couple more charts there. Just the bottom right one showing you that I think there is a positive correlation between price and occupancy. Some questions I get is whether the high prices are holding off occupancy. Actually, the highest returning occupancy states, Maine, Montana, Vermont, also have the highest pricing. What about the impact of interest rates? Well, we've got a note out tomorrow, anyone who does see our research, where we'll be talking about how rates really don't correlate that well with hotel construction. Really, hotel construction is on about a 3-year lag to hotel performance. That makes obviously a lot of sense. And you're now just beginning to see the global hotel pipeline begin to turn around. It's had a couple of years of declining. It's beginning to turn around. The big story, I would say, within it is the sort of growth of the branded share of that. Brands are gaining an ever bigger slice of the share of that pipeline. So you're seeing branded growth hold up, and that's even really before the conversion. So you're seeing the consolidation of the hotel industry actually go faster as we come out of COVID. And maybe that's one of the impact that affects this. This is probably some of the research we're maybe best known for, is that the OTAs have actually lost share. Most of the time, OTAs are covered by internet analysts, not lodging analysts. And so when we compare the total number of hotel rooms sold by Booking and Expedia relative to the hotel market, we see that they've lost share. There's differences between Expedia and Booking, and we talked about how there's different priorities within those two companies, and we can debate which one of those is the right strategy. But together, probably for the first time in their history, the two companies have lost share. Part of that will be down to the branded share gains. There will be other factors in that as well, which we can maybe debate later. But I think overall, we're probably entering a pretty good time. I mean, I think that the next 12 months are going to be dictated by recovery versus recession. Which one of those two factors is going to win? We think recovery is more important. But we are in a world where hotel demand, overnight demand, this is just overseas, grows at about 4% a year, 4% CAGR really over the very long period of time. There's lots of drivers of that: airline capacity, middle class population. But there's not going to be enough supply in certainly the hotel market to fulfill that. And you saw that factor begin to come in just in the sort of few years from about 2015. You saw that the occupancy gains were running out, and you're relying on supply growth to fulfill that demand. But there's not going to be as much supply growth. The actual total pipeline is still down. So you're going to have less supply growth, not enough to match demand. What wins from that, in my view, it's vacation rentals. You know, something's got to plug that gap. When you've got a mismatch between lodging demand and lodging supply, something needs to plug that gap. Where is all the shadow supply? For me, it's in the vacation rental products. It's in the Airbnb product. I've spoken to some of you about this already today, but we see that from about 2015, vacation rentals were gaining about a percentage point a year, just at the exact point that hotel occupancy maxed out. And because hotel occupancy is not far off getting back to that 2019 level again, we expect to get back to that trend. We're quite bullish on the forward demand of vacation rental penetration, particularly in emerging markets where there is a very good correlation with internet penetration. There's still further to go on that. And then I think for some of the longer stays, we've heard people talk about digital nomads already today. That trend does not run. There's still more demand for more people to want to be nomadic. Now, the pushback we often get is, okay, the demand might be there for vacation rentals. Will the supply be there? We see it as a rational force. We do think there'll be more supply out there for vacation rentals. And actually, I'll just do the charts on the left-hand side here are probably the most telling. In the US and the UK, less than 2% of properties are listed on Airbnb. In both of those countries, the number of properties that are second homes is about 3 to 4%. There's lots of supply out there that isn't listed on Airbnb yet that could be monetized if the demand was there. And if you go to more touristy countries like France or Central Florida, you see a much higher percentage of properties listed on Airbnb. So we think there is the supply out there. It comes on when the demand factors that. Last couple of slides, as I say, I have to talk about AI. Apologies if you can't read this one, but this is from a joint report by Microsoft and Amadeus that really showed that there are frustrations, actually, funnily enough, more from business travelers than leisure travelers, that they are restricted. Rafat likes to call it the tyranny of the search bar, that you are limited to searching by budget, by date, by location, and people do want to break free of that. And so I think conversational AI, generative AI does help you do that. You don't have to know where you're going to go. You don't have to know when you want to go. Airbnb's starting some of that, but it's moving on. I think maybe that's probably non-controversial, maybe where a little bit more controversial is who's the winners from this and what effect it will have on the industry. Google Hotels, we've had Google talk today about this, and I think maybe the consensus view from some was that Google will lose out on this. I think that Google's a powerful weapon in a mover in travel because it is fairly result agnostic. It doesn't really care where you end up clicking through for as long as you use the product. It just wants you to use it. And you've actually seen that over the last 3 years, they've lowered their cost of distribution quite a lot. So they haven't worried about maximizing the cost per click. They've worried about the usage. And by doing that, they've actually increased their revenue with a sample of hotels from DH by about 13%. And I think that attitude that you're kind of result agnostic makes you a better user of that. If you go over to Booking, where obviously they've got a lot of data and they can use this, they are not result agnostic. They want you to click on the hotel that is paying the highest commission. About 10% of their revenues come from the preferred and preferred plus programs, the ads, etc., that are on there. They want to direct you to those things. That's a very sensible strategy. But for me, a conversational AI bot, a good one, would be one that is result agnostic, that does send you to the best hotel for you, not the best hotel for the platform. Now, Booking might be able to use that, but I do see it a little bit of a threat to what is one of their key revenue-generating models. Hopefully that was just a few useful thoughts. I will exit the stage and then come back onto it again to do part of the panel. So if there's any questions, we can answer it then. Thanks very much.